Okay, thanks you for the waiting. Good afternoon, everyone. This is Hanting from Phillip Nova. Welcome to today's webinar. Today, we are sharing on navigating through rising interest rates and inflation in 2023. The Director of Portfolio Management in Phillip Capital, Martin, will be your speaker for today. Martin is experienced in business development in financial services and wealth management. Also, he has been involved in launching ETFs since 2016. During the webinar, if anyone here has any questions, you are welcome to send them to the question box at any time. And at the end of the webinar, we will try our best to respond to them. Without further ado, let's welcome Martin. Hello, Martin. You can unmute yourself. Yeah.
Okay, so yeah, it's a bit different for this go-to webinar. All right, can you please look at the QR code? My name is Martin Chong, Director of Portfolio Management of Phillip Capital Management. So please scan this QR code so that you can access to our so-called documents, fund documents, and then please look at it, and then for your readings pleasure, for you to study about our ETF, and then basically this is the first REITs ETF that launched in Singapore. Then we are actually very pleased to share with you. So far, the performance has been doing all right. Serve as a very good investment tool to hedge against the inflation, to hedge against the others investment product. Right. Without further ado, let's move on. Okay. So basically, these are the Asia Pacific region that we are talking about. That this REITs are covering as well. It's actually ex-Japan, because Japan alone can be standalone, quite huge market. So market size for the Asia Pacific, basically we are looking at the very important one will be Singapore, Australia, and Hong Kong. Okay, so you need 3 ingredients, okay, to make this recipe a success. Okay, the formation of this REITs markets, right? In any markets, okay, in any markets, it's very important. You need number one, you need a quality sponsor. Who are the sponsors that we're talking about? Okay, they are, let's say, CapitaLand, Maple Tree, Center, okay, GPT. These are the REITs operators. At the same time, they are backed by government pension fund, government linked company. Okay, so because without that, without the strong balance sheet, without strong capabilities in providing financings or this for to purchase asset, or the asset enhancement, or to be able to buy more assets. Okay, so they call it asset injection into the REITs. Okay, so that you need that kind of a purchasing power. You can have bullets to make it a success. And secondly, of course, it's a law. Okay, regulatory framework. What means here is that you need a very conducive regulatory framework, okay, to make this REITs a success. Okay, why in some of the Southeast Asia country, or even though Asia country, including China, why some of the institutional investors are not happy with their REITs, simply because there are many loopholes. There are many unstructured law or so-called friendly law, okay, to make these REITs operations a success. Okay? There are many so-called many factors, but mainly because Singapore can do so well. It's because our regulatory framework is quite solid, okay, very conducive, right? And then the third one will be the catalyst. Okay, this is a very important recipe. Asian country has been urbanized, country has been developed. Okay, like for example, you see Vietnam. Okay, how the city of this Ho Chi Minh City and Hanoi has been urbanized. Okay, developed, and more these good assets will be injected into the REITs. Okay, potentially. So this is a fact. Okay, this is a fact that the Asian is growing, country is developing, city is being urbanized, then more and more good assets will be injected into the REIT. So it's a catalyst, or it's a perspective play, good prospect, center of growth. Okay, so you need these three ingredients to make it a successful recipe. Okay, then of course, like I mentioned just now, prime property, all these properties are at prime location. Okay, uh, distribution per unit grow is about 4-5% kind of thing. So blue chip. All right. Also, another thing that I highlighted just now, urbanization, development, proxy to Asia's growth. So the outlook is positive. It's different from Singapore perspective, where it's very small, slightly smaller kind of perspective. Where I talk about Asia Pacific, Hong Kong, Australia. So these are the regions that are doing well in REITs, and also very volatile and exciting for the REITs market. And then of course diversification. Asia Pac kind of REITs is actually able to allow your investment to diversify from the residential basis. I mean, diversify from Singapore, diversify from Thailand, diversify from Malaysia, that kind of thing. Okay, so it's a good geographical coverage. Okay, all right. Then we talk about the benefit of the REITs investment. Some of you might think that, okay, REITs, what is REIT? Okay, REITs allows you to access to the passive income. Okay, what mean passive income? You sit down and relax. Every month, every quarter, you receive dividend, or every half yearly you receive dividend. So that is also very important, okay, for the retiree or for the pension fund, for the corporates that wanted to grow their money. All right, and then relatively liquid and flexible. You're not subjected to stamp duty, lock in 5 years, MOP, that kind of thing. Okay, no local government restriction. You don't have to worry about that. Okay, you can buy and sell through the exchanges easily, and then peace of mind. You don't have to worry about the maintenance. Then you have regular income, 4-5%, 4-6% per annum, and then quality investment. So Asia's top properties that you hold. All right. So these are the very important things that to make it a success. Without this, all fail. Okay. And then this is also the features that the benefit that invest into REITs. Okay. So this APAC Dividend Leaders REITs ETF, right, is actually focusing on this, the quality, focusing on the total dividend payout. So these are the company REITs that pay out in terms of dollar. It's not in terms of percentage. So the more the payout, the more the better. Right? They will be selected. And also we're looking at the liquidities of these REITs. In terms of the trading velocity, liquidities, okay, and then whether it's liquid or not liquid, and low cost, okay, very low cost, okay. And this index, this ECF is actually tracking the SGX IH APAC Index, REIT Index, okay. So REITs has been outperforming. This is show you, okay, for Singapore context and then Australia, okay, they are doing in terms of this last year they were doing not that great, okay, they were not doing that great, but this year they've been doing fairly okay, all right. And then this global REITs performance, just a glance for last year. This is numbers that you look at it. Year to date was 1 month. Okay, last month the whole REITs market in the world actually outperformed. From starting from Australian REITs, Singapore, Hang Seng, and all this. They actually positive, except the Tokyo, the Japan one. All right, so this is to give you a guide. And then for last year, if you look at 1 year performance, it's 12 months, 1 year, year-on-year basis. So European REITs is no, yeah, they've been doing very badly. So it's time to look at certain things, certain strategy. But when we look at the Asia Pacific, yeah, just look at Hang Seng. Okay, they are doing badly last year, 30% down. But year to date, last month they performed about 10%. So including Australia, including Singapore. Singapore last year was doing so about -5%. So it was flat. Okay, it was flat. So if let's say you have the investment into this kind of strategies, what it tells you is that, okay, rotational play, cyclical play, actually come with the picture. Like it or not, they are doing fairly all right. They're doing fairly well. Okay, they're consistent. Okay, not that -20%, -30%. No, Singapore is still fairly okay, including Australian market. Okay, so APAC GDP, we're looking at this. This was 2 years ago number, so quite close as well. Quite close now. The reason why we highlighted these 3 countries is that these are the more developed REITs market. And then when we do calculations in terms, okay, so you would like to know, okay, the trading velocity, liquidity. You would like to know how much dividend payout. Let's say CapitaLand pay 100 millions of dividend. Okay, compared to ABC REITs pay 10 million dividend, but ABC REITs dividend yield is about 10%. CapitaLand is about 4%. So in this context, CapitaLand still be selected. Okay, because we are looking at the number of the dollar sign. Okay, the dollar and cent that pay out. Because the more dollar they pay out, it shows that the strength of their capability in terms of the continuous to pay a good dividend. Okay, solid payment. The consistency is very important, right? So when we do when we press the button, because we set all the selection criteria, we want the liquidity, we want dividend payout, we want the companies that have a good dividend payout. So when we have this kind of combination, this kind of ingredients, okay, and then when we press the button, these 3 countries somehow came out, and then Australia being the heaviest one in terms of weightage. Australia has about 50% in this ETF strategy. Singapore has about 35, and then Hong Kong has about 15. Doesn't mean that Thailand or Malaysia not qualified. They used to qualify some of in a certain during certain rebalancing, but somehow they've been kicked out by the index over time, right? Because they are not as good as these 3 countries. Okay, so it's a superior yield over time. I would like to share with you. Look at the 2022, the inflation versus this REITs yield. REIT deals for Singapore. Okay, this year we're expecting about so-called about 6%. Okay, and then inflation of course is 6 to 5%. Okay, so you need to beat the inflation. Okay, you need to beat inflation. Of course, this year coming down. Okay, till 2023 it's start to coming down. So let's say you were to look at the all-time average, right? All-time average here. Okay, so it still beat the inflation. Okay, over time it beats the inflation, including Australia as well as Hong Kong. So it's a good inflation hedge. Okay, provided you need to invest into a longer term. Okay, some of the investors do not have the you can't buy another property anymore due to the restriction. So they still love property because of the passive income that they receive. The best thing is encourage your investor to invest regularly, okay, or you yourself invest regularly into this REITs ETF. Okay, for this I can show you, yeah, sustainable growth. Okay, even though up to 2022 they are doing all right, because especially this year onwards it's a so-called recovery year, and we expect more dynamic into these three country so REITs as well. Dynamic rebound. Okay, so when you look at the fixed income investment or REITs investment, you should look at the yield spread. Yield spread is what? Yield spread is the opportunity cost. Okay, it's opportunity cost that you invest into the government bond, which is a risk-free rate. Risk-free is very high for Singapore bond. Used to be 0.8, now it's 3.2. So a lot of investors actually shifted the money into this T-bill as well. All right. So when we come to this picture, we are looking at the yield spread, the difference between the dividend yield and the risk-free rate. So the larger the gap, the better. Okay, we need to say the yield spread 3% is better than 2.25. 4% is better than 3%. So average Singapore has about 2.5 to 3.5 kind of a yield spread range. So it actually shows that it's a good investment. Okay, it's a good investment to hedge or to serve as a defensive investment strategy. Okay, and then inflation, yeah, this is not new. We would like to highlight here is that look at the 40s, 1950s, 1970 oil crisis, and the 80, and year 2000. Yeah, okay. So inflation is happening. Okay, and then it followed by the recession. Why? We will explain later. Next slide. Okay, what we see here is that U.S. inflation was about 6.5 in December. Okay, then this in January I think it's about 6.2. Whether or not Federal Reserve has been able to contain the inflation, but we see a very minimal impact that they can stop the inflation. Then what shall they do? So it's a very good question we keep asking the central bank or Federal Reserve. Okay, have they done a good job, or they just simply increase the interest rate so that they can invest? It's the best so-called formula to cope with the inflation. Whether they have done a good job, so far we see the very little impact to manage or to contain the inflation. Okay, although it has been coming down, but some of the economy, the data indicator indicates that the economy is not good. Okay, simply because as you may know, the tech giant has been cutting jobs. Okay, from United States to Asia now. Okay, Google is retrenching some of the how many people? 3,000 staff global year worldwide, right? So, and then the Singapore one is actually happening last Friday. And then yeah, we see this kind of trend is continuing in US or global tech giant, okay, company. Yeah, because they have to downsizing, they have to rationalize their operating costs. Otherwise, it's tough. And what I show here is that crude oil prices over 30 years now standing about 78. So because of the high oil prices and all these phenomenon, inflation will stay. Okay, inflation will stay. And also we talk about the yield spread. 10-year US yield is about 3.8. US 2 years yield, 2 years government paper, right? 2-year treasury paper or treasury bond is about 5%, about 4 and 5%. So or 3 or 4 point something percent. It's higher than the 10-year. This doesn't make sense, because the 10-year normally is you hold it 10 year, you then investor you tend to have a longer risk, okay, longer tenure or risk, higher risk, and then your return should be higher. But somehow this thing happened. The 2 years bond, the return is higher than 10 year, and it's still happening. Okay, so whenever this thing happen, right? Okay, if the recession will kick in within 6 to 12 months, and we see this. This is the sign. This is a sign. Just a sign. It's not to scare you, just to share with you where we are now. What are strategies that you need? Okay, what are strategies that you need? Let's say let's say you do trading. You know how to short the market, what to buy, buy gold or whatever. So these are the strategies that you got to put in your thinking cap. Consider whenever you want to invest, what kind of strategy you are looking at. Okay, so we are here. We are here. So yeah, recession in US is near, so-called near. All right. So this is the withholding tax because the ETF invests into the various market. Australia, you have a 15% withholding tax, and then if let's say those green commercial building, they have a 10% withholding tax, 5% cheaper than the normal building. And then Hong Kong, the best, no withholding tax. Singapore, we have 10% for foreign investors. Okay. Okay, so regional REITs hold renewables prime location and iconic asset. This is phenomenal. You go to Australia, you go to vicinity centers, you go to Center Group. Okay, it's used to call Westfield, now it's a Center Group shopping mall. Okay, and Singapore, you have a Ngee City, Star Hill, Raffles City Tower is where our headquarters is, and Hong Kong, you have a Lok Fu Plaza, and then which is owned by the Link REIT. Okay, and Link REIT was down about 30% past 2 weeks. A week before was because of they want to do a right issue. Then that's why it was affected. Okay, and nonetheless, for long-term holding, 3 to 5 years, it's still a good asset. Because this is the largest REIT, about what size, about 15 billion. Okay, that owned by the Hong Kong government. Okay. So Asia Pac ex-Japan dividend leaders REITs index methodology I mentioned to you just now is actually those REITs that listed on Asia Pacific exchanges. Okay, Singapore, Thailand, Malaysia, Hong Kong, Australia, Thailand, Indonesia. But when we set this, okay, proportional free float 20%, more than 20%, it must be market cap of 300 million and above. Most of them qualify for this. But we talk about the velocity, the trading volume. Okay, wow, how fast each exchange change, that they call it trading velocity. And then the dividends value must be more than daily trading volume must be more than 400,000 a day. So it must be very liquid. And then we are looking at the 30 stocks on it that pay total dividend, the dollar and cent pay. So with this kind of ingredients, right, you put into, you probably will select, let's say you select 30 stocks, you probably will select the best of the best REITs in Asia Pacific. So this strategy is so-called smart beta. It's not based on market cap. The larger the better. No, it's actually based on the liquidity. Based on this type of strategies, actually allow you to sieve out the good quality company, the good REITs. Okay, so you see the sum of dividend pay and the dividend yields rate is different. So actually, this portfolio, right? This APAC REIT ETF is actually based on the total dividend payout. It's not on the market cap. Okay, so this is what we can see in the, I think in the fund fact sheet as well, the top 10. GBT, their debt over asset is about what, 20 over percent. They are one of the so-called fund managers baby. They love it. We visited the property that owned by GBT in Sydney. So they are doing very well. Okay, their debt over asset, right, is less than 30%, whereas our Singapore one is all 40%. So Singapore REITs still have a long way to go in terms of improve their debt over asset holding. And then GPT also own the ANZ Tower, then as well as the Citibank Tower in Sydney, at the Pitt Street and on Queen Street of this Sydney city. Okay, and it's very easy to find near Martin Place of this Sydney CBD. And then Center Group that own the so-called shopping mall. Stockland also own some industrial, some we went to see their retirement housing as well. Okay, and the suburb of the Sydney. CapitaLand that owns Raffles City Tower. Okay, it's a value of 3 billion Sing dollar. Okay, it's one of the crown jewel, Raffles City Tower, where our office is. Okay, so these are the good qualities company, good solid REITs operator. All right, and then when we press the button, we have these 3 countries, okay, being selected. We are never restrict this South Korea, China, Philippines, Taiwan, Indonesia, Malaysia, India. Okay, no. Okay, and then diversify. Mainly diversify. Mainly their sectors, right? All these assets. Mainly shopping mall plus retail, and then also we have a retail as well, 1/3, and then industrial 11%, offices 11%. Okay. Because of the recovery kicks in and then recovery play, actually we see more and more Australian REITs outperform the market. Yeah, quietly they will do well. So before the market really runs, these are the REITs that are already selected by the index. Okay, in December we actually rebalance the 3rd Friday, right? We rebalance the portfolio. So these are the latest one. Then I think the dividend is about dividend declared net was net of fee, net of tax, everything. It was 4.8. You can check on the where this. Sorry, it's 3.78, not 4. I was wrong. I read wrongly. Okay, it's 3.8, not 4. Sorry. The dividend yield for inside the underlying portfolio, okay, it was 4.8. Okay, so yeah, this is the price to book is 1.02, which is close to 1, meaning to say it's at fair value. Okay, so this strategies, you can see along the way, we launched it in 2016 about this range. So then it came down, then it goes up again. Then it came down. Yeah, it came down, and then it again is at this level. So it used to be at this very high level. We believe that it will come back, okay, in 2 years, 3 years time. Maybe this year they will do wonder. We don't know yet, but we see the recovery seems to be very promising. And then we would like to share with you where are we now and then the strategies that you can use. Just a guide. Just serve as a guide. Okay, the blue or the green being the market, the pink one is being the economy. So market always move before the economy. Okay, market will always move first. So where are we now? Where are we now? Basically, we are this area. Okay, we are this area. Okay, we're not at the bear market yet. We are about this area. Recession also, we're not yet. So we are about here, right? So what kind of strategies to use? Okay, you use value, you REITs, you use income strategy. So these are the on my market. Keep cash and carry on. Okay, so these are just a guide, serve as a guide for you to understand where you stand in the market. Okay, so when the recovery shakes, of course you will buy everything, tech, finance, all these. That's why 2020, okay, after the March when market came down, so all the tech stock was outperformed, but last year was disaster to them. Okay, okay, and then we'd like to share with you the key takeaway. All right, you see so many slides, maybe you confused, but one thing we would like to reassure you is that, okay, border reopen, it tells you what? Hospitality REITs, retail REITs, okay, and then dividend hikes. It's already happened. It's already happening since last year. We see the improvement of this dividend for Singapore REITs or for Australian REITs. So everybody is paying higher dividend yield now, and then high inflation. Yeah, we have to face this high inflation. Are you still not investing or keep cash? So it actually erode your purchasing power. That is for sure. But if let's say you think that it's safe to keep in FD, go ahead. Okay, but the FD also start coming down. Okay, we used to get about 5.35 for US dollar 12 months, 5.35%. Came down to 4.85 now. Okay, so it's already coming down. Just very sharp. Go up 2 weeks, then stay for a few weeks, about a month plus, then come down. Okay, so the portfolio is actually our active portfolio is based on bottom up, but this strategy, the thinking was that when we set this one, we want to look at how we bottom up. So we set the parameter. So we set this parameter. Okay, the total dividend payout, the trading velocity, trading volume a day must be this. Then you set this so-called parameter. Then you will be able to sift out the good counter, good mix. Okay. And then of course the we would like to highlight is that it was prolonged weakness in hospitality. So it was slow down in last year, 2022, but we start to see this hospitality air travel to come back in the first quarter of this year. Okay, but it's subject to the backdrop of the inflation. Then we will have to wait and see. Okay, hold your fire. Then Australia, Singapore, Hong Kong will be benefited. Okay, when the recovery of this economy kicks in. Okay, so yeah, this is the REITs that managed, the ETF that managed by us. Yeah, and then okay, so I will stop right here. Okay, no, yeah, I will stop right here, and would like to take the question from the floor. So happy to take up the question. So if you have any question, just do let us know so that we can answer you. Okay, so if no question, so we thank you very much. Thank you for your participation. So we're happy to end this session so that you can anyway, if let's say you think that you have questions, you can always check with the Phillip Nova site, then we can send through email. We can answer your inquiries and all this. Okay. So thank you very much. Thank you. Bye bye.
Oh, thank you, Martin. Yeah, thank you for your sharing, and to everyone in the audience for participating and listening. Also, thank you. Yeah, thank you for listening. And we now have a campaign. Say if you open account and fund 3,000 Singapore dollars, you can get 128 on Hongbao. In addition, we will record the webinar and send it to your email. If you have any questions, you can reply to our email or visit Phillip Nova's official website and leave a message. We will contact you as soon as possible. Thank you again for your time, and that concludes our webinars for today.